For that, let's begin the show. We've got lots of corporate conversations going on. First up, WeWork India reported their Q2 numbers. The company's top line went up by 17%. EBITDA margins came in at 20.3%, slightly lower compared to the prior quarter. Karan Virwani, MD and CEO WeWork India, is joining in. And Karan, congratulations. I think the company has achieved Ind AS PAT of 6.4 crore, which is the first true profitability if you strip out the tax credit from last year. So congratulations on that. But let me start with the top line and the margins. Revenue growth for you was about 17.5%. And yesterday we were chatting with a peer of yours, IndiCube, and their revenue was in excess of 30%, and they're confident about 30% sustaining for the rest of the year. So, juxtapose your performance with the industry in Q2 and what you expect on the top line and margins in H2.
Sure, Will, and thank you so much and good morning. I think to start off with on the capacity side, if you see year over year or just from last year, we've grown over 21%, which is higher than the industry, the rate that the industry has grown. So capacity has grown. At the same time, we've seen occupancy move up drastically in the last 2 quarters, nearly 5% of occupancy add from 76 odd percent to now closer to 81% for this quarter. Revenue has gone up, like you mentioned, to 585 crores, which is our highest ever revenue, 7% quarter over quarter, 17% year over year. And just to correct, IGAP EBITDA, which is about 118 crores, has grown almost 45% Q over Q to now about a 20% margin, right? Which we're seeing with the business sort of ramping up and occupancy sort of moving up as well. And rightly, like you mentioned, 6.4 crores of actual proper operating cash, which was negative 34 crores just a year ago. We've seen that transformation and now hit this big milestone for the entire industry as well. If I have to just draw a comparable, I don't want to mention about other operators, but if you just look at the revenue base that we have, it's nearly 30 to 40% higher than anyone else in the industry or some of the industry benchmarks. So there is a scale factor playing in here. I think at lower revenues, we were growing upwards of 40% as well. Today, we're growing at, roughly about 17, 18%. Versus our net license fee has grown over 22% in the last 1 year itself. So we believe that the business at scale still continues to grow and will grow above 20%, and you will see that ramp up happen over the course of the year as well.
So 20% plus revenue growth, Karan, in the second half of the year?
Yeah, I think overall, just year over year, that's the type of growth that we're targeting. We think that we are on track to get there for sure.
Karan, thank you for joining in. What about margins, as Rima was asking? And you've also earlier highlighted about wanting to be an infrastructure partner for GCCs. We heard you speak about it during the Global Leadership Summit as well. What is your strategy with regards to that? And of course, first your word on the margins.
So margins, are growing healthy. If you just see the EBITDA margin, which we measure on an IGAP basis, last quarter was about 15%. As of Q2, it's grown to about 20%. So that's been a 5% increase in margin. EBITDA was about 81 or 85 crores last quarter. It's grown to 118 crores this quarter, which is a 45% increase in the operating margin. IGAP equivalent PAT, which we also look at over the last few years, was at about 40 crores, which is about a 6.7 PAT margin for the quarter itself, and nearly 47 crores for the entire first half of the year. So business is operating well. Margins are hitting. Operating leverage is kind of kicking in, driven by demand and occupancy ramping up. And mature centers now are upwards of 84, 85%, which was nearly about 79% just 1 quarter ago. So we've seen a big ramp up in the occupancies of those centers as well. Our operating or our growth centers are also now operationally breaking even at a much lower occupancy than the portfolio. So that shows that the operating discipline in the new cohorts is also starting to play out, which will soon reflect in both the revenue and the margin coming in. Just an interesting point, almost 80% of our incremental revenue from here will basically flow down to EBITDA and then finally down to PAT as well. Just touching on, your point on GCC as a service, Yes, we are looking at productizing the entire GCC as a service platform. We're very focused on delivering just the infrastructure part of this. So that starts with workplace delivery, being able to have multiple models like an entry model, a scaling model, and then a maturity model for GCCs. Over and above that, we're doing services like transport, F&B, employee engagement, and even offering design build services for certain companies that just want their own space. The idea is to finally move WeWork from co-working to, doing enterprise grade offices, which we're already doing and is about 20% of the business, to finally a proper infrastructure or workspace as a service business where we're able to offer flexible spaces, long-term permanent spaces, but also cater to all type of design, build, operating requirements that companies might have in the future.
Karan, many more questions, but unfortunately out of time. Thank you very much for joining in. That's WeWork for you. Slip into a break. On the other side, we'll focus on crypto markets with Adib Nurani from Market Wizard. Stay tuned.